Good afternoon. Welcome to this interview for the Center for Financial Markets at IMT Ghaziabad. My name is Aditya Azad, and I have with me Somash Girdhar. We are first year PGD and BFS students at IMT Ghaziabad. We are honored to host Mr. Suraj Malik. Mr. Suraj is a renowned and distinguished professional with 20 years of experience in merger and acquisition transactions, strategic finance, private equity, and venture capital. He currently advises family offices with succession planning, wealth management, and investments across different AIFs in his capacity as the founder and CEO of Legacy Growth. He is a chartered accountant by training and has experience working with marquee firms such as PwC, EY, Jindal Stainless, SBI, and BDO India. Thank you, sir, for taking the time of your busy schedule and joining us here at Center for Financial Markets at IMT Ghaziabad. Without further ado, let's delve into your experiences with family offices.
What roles do
Sure.
professionals play in a family office, and how do they add value beyond M&A and investments?
So it's important to first understand what a family office is, and then we can add to what professionals or what some of you can also shape up your careers to be, right?
Right.
So essentially, when at a family level, right, and this is all families who've been in business, who've created wealth, who've generated profits, have grown in size. Their investments, their wealth, strategy, the risk, reputation, all of this needs greater degree of attention and focus. Uh, and just like there is a formal office on the corporate or the business side, that formalization of the family starts taking place. And that's what a family office is. And when professionals come in, really you start professionalizing the entire journey as well, right? On how does a family take decisions? It's no longer over a coffee table or over a dinner in a informal, unstructured way, but there are people in the family office who are presenting data, facts in a more structured, organized way, and that is being used by families to relay the decisions and also to sort of run with the bait and drive it. Commonly, these are investment guys because a lot of active work that happens at families related to investments, both in their business and outside. But there are also need of professionals in today's time and age to deal with things like tax, legal, uh, media interactions, and a lot of lifestyle concierge services as well, which families don't want to. Let's say today we're in a phase where all these concerts are happening all around, and uh, families have to be mindful where they are gone, with whom they are found, and how their overall logistics are better planned. So and they can't get a corporate person to do this, right? So this demands, even good concierge lifestyle services demands professionals to get involved.
So, sir, talking about the investments that you just mentioned, right? Um, Recently, there has been an uptick in direct investments being made by family offices and startups. To take an example, Jiva recently raised 100 crores in an extended Series B, in which Premji Invest, which is the family office of Asim Premji, also invested. So, do you see this rising trend challenging the dominance of venture capital in early stage investing? And a corresponding question to it, what do you think about the risk profile as investing in a VC fund would spread the risk across multiple startups?
Sure, I think so. I'm just connecting to the previous question, right? Just like family offices have come of age and they've grown in size and sophistication with professionals. They dabbled with this asset class, which was alternate earlier through VC funds, where there was a professional running it. But sometimes the size of the bite that they got as part of the fund on a deal was, far smaller than, the outcomes that, they wanted. Uh, and now that they understand trade, there are professionals sitting within the family office looking at investments, evaluating this asset class. Plus, the access has also improved, right? A founder or a deal looking for money knows that, this family is no longer traditional or no longer just looking at real estate, gold, or public equities. So when they start accessing deals and have professionals to understand, they start operating VC like. They would still, co-invest with or alongside other funds. That gives them comforts that there is a professional validation there, but they would invest directly uh, and want to aim for those larger sort of risk-adjusted outcomes. And wherever they see a lot of family offices end up investing in businesses that are adjacent to what they are doing, because that gives them access to or closer understanding of the tech, the team, and also sort of improves efficiencies in their core business by working with this new age tech founders or new age startups.
Right. Okay.
So let's now talk about the broader topic of merger and acquisitions. How does a volatile economic environment, for example, inflation and recession, influence merger and acquisition deal making and valuation?
I think economic environments have always been volatile. It's just that we see that at a point of time. And volatility brings opportunity. So in any M&A, if you look at situation, right, there's a seller and the buyer. And trade do happen when, a seller blinks, wants to sell, and a buyer sees value, right? Buying. If someone was buying at a full price, how would the buyer ever make money? Now with volatility, there is uncertainty, and the lens of the seller and buyer start seeing that risk with volatility differently. Buyers tend to be more conservative the higher the degree of volatility is. But at the same time, the inclinations of seller to sell when they're not able to deal with volatility is high. And that's where, you will see more activity that happens and more trades that get consummated in a very stable, steady environment where no one is blinking, neither buyer or seller. Deals take longer to consummate. Having said that, with scale also, right? Like in India, a lot of businesses that are family owned are growing. There is ability to deal with volatility at a scale which traditionally they've operated, but suddenly with the scale or the channels of accessing with so much, it used to be online and offline. Now there's quick commerce, e-commerce, logistics. I'm saying there's volatility around everything there, and a lot of business M&A happens because people are comfortable with volatility, but not volatility at scale. And it requires a different degree of capability and capacities to run larger businesses. And that's where you will see within an industry a lot of roll-ups and all happen because the larger players will tend to do M&A to be able to sort of run one large ship at scale.
So, next would be what are the key differences between inbound and outbound mergers and how do they impact the strategy?
So as the name suggests, inbound merger, and this is India, let's take India as a context, is any foreign entity merging or doing an M&A with India, and outbound is, an Indian headquartered company going global. But if you look at it from an international lens, both of these are cross-border M&A, right? Which is businesses or groups across locations or even governments, right? Today are indulging in this, looking for resources or strategic supply chain tie-ups. The complexity, of course, there is familiarity for people operating. Like people in India will find India familiar, people in US will find US familiar, so on and so forth. But a foreign land is always unfamiliar in terms of regulations, in terms of governmental support, in terms of labor markets, etc. And it is harder to do greenfield projects, right, in unfamiliar territories. So people who want to grow, diversify businesses will end up looking for these brownfield existing M&A projects as a way to sort of enter a country or as a way to set up presence, especially in sectors that require larger investments like manufacturing, or work with a local JV partner who can sort of help them navigate through the local issues and challenges. So in both this, there is again heightened interest today growing on because half the globe is fighting and the remaining half that is peaceful and is prospering. And within that, both on the inbound, you'll see Indian groups, look outbound, and outbound looks group, European Western companies coming here. Even within region, right? While we say that Dubai, Saudi are rich countries, you will see that other countries are going there, but their local companies are going global. So it is always aspirationally that people want to, whichever market you are in, whether developed or undeveloped, you want to go to the adjacent or the next market to, explore growth pastures on what you can do better with your home strength. So in India, you would see more outbound in things like KPOs, PPOs, you would see auto, because these companies are able to leverage their local strength and IP knowledge and then take it to the globe. Sorry, you're on mute, Aditya.
Apologies. So you just spoke about key considerations, looking at it from a strategic point of view. If we were to look at it from a financing point of view, right? So a cross-border M&A transaction, outbound or an inbound, what would be the key considerations there from a bank's perspective, or from the investment bankers and the counterparties perspective?
So financing in cross-border is very tricky. Just like people don't understand businesses, it's hard for a investor to sort of lend money to a foreign acquirer. Uh, Again, the risks are there both in terms of enforcement it legally across borders. It is also in terms of, uh, you know, rating and knowledge. Like some of our largest companies who are, very big in India and we find them great are internationally not rated top notch when it comes to their competitors. So there is of course the rigor involved for someone to do financing is higher, to assess, to know the KYC, to also ensure that there is no money laundering or nothing else that changes the route on purpose for which the money is being borrowed and where it is eventually used. Uh, that changes. Having said that, this is a far developed side internationally than in India. So there are some specialist funds. There are banks who are institutional wholesale banks who specialize in cross-border M&A, and they have some very unique products structured for it. I think the Indian landscape for that is still being evolved, given how RBI controls banks in India and how private capital is also there. That it is like our banks are not allowed to lend for M&A in India. That's RBI diktat. But this rule doesn't sort of apply internationally. So there is structuring. There is a huge mix of, debt is cheaper in most countries, risk adjusted. So a lot of Indian groups, when they go global, they try to first get recourse to debt, or otherwise they would raise money in that local market with a local JV partner or an investor who wants to sort of partner the Indian conglomerate to do a venture in that host country. But it is not easy. It is, I think, one of the most difficult parts when it comes to sort of actually executing M&As, to tie down the funding and to meet all the various covenants, whether it's equity, debt, or hybrids, and to get people to shake hands to go ahead, in a time-bound manner. Right? These are also time sensitive.
That makes sense, sir. Right. I'll just
Sure.
Sure. So, sir, you just mentioned about a hurdle in cross-border transaction being the banks unable to finance those things, and then companies looking for those financing outside. So, looking inward, looking in India, what are the most common regulatory hurdles faced in M&A transactions, and the involvement of major bodies like SEBI, CCI, and NCLT. So, how can companies better prepare for these hurdles that they may face?
Yeah, India is slightly over-regulated, let me put it that way, when it comes to M&A transactions. But it is all in good intent, and it is meant to again safeguard, interest of various stakeholders, including banks, sometimes minority shareholders, and so that people are not very creative on tax and try to avoid that. So we have, for larger transactions, there is Competition Commission. Their lens is to just make sure that where there's M&A or two people are combining or trying to do something, it doesn't sort of impact the market forces or lead to any sort of cartelization. But the thresholds are high, which means transactions above a particular thresholds work, and smaller transactions, MSME transactions, early stage startups are not impacted, right? So it's not, you'll not find CCI figuring everywhere. SEBI likewise is meant for entities that are listed or to be listed. And it is really out there to protect interest of just like competition commissioners of customers and of ecosystem. They're for minority retail investors, right? So they want the right level of disclosures, they want the right level of reps and indemnities coming in case something goes wrong, and they want to hold certain regulated entities like merchant bankers responsible as well. And there is a process to be followed, but again, both these regulators are business friendly, and if you follow the process right with the right paperwork, it's done. Then comes to taxes, both direct and indirect tax. Again, over the years, they have been liberalized. Laws have got clarified. Some litigations that used to happen, at least now there is within the law, it's codified what the answer is. Good or bad, at least the clarity has emerged. In spite of that, as I said, while SEBI and CCI normally process, tax is a cost, and people try to then get more creative or try to optimize the cost. And likewise around also for something like stamp duty, which are cost. And that is what then creates some amount of friction or hurdles, right? Because if you try to do workarounds or try to plan, I'm not even saying avoid, but legitimately plan, it does bring with it, some positions that need to be taken, or certain, structures that need to be followed. Let's say in India, if you just simply acquire shares, you pay tax, but if you structure M&A through a merger or a demerger or something similar, you could defer taxes or claim tax neutrality. So that the tax and the stamp duty and other transaction costs like GST credit, they will drive the timelines and the structure of the solution. And it can bring in fairly tangible savings at times. Everything else is more procedural, as I said, little higher than the globe. But the regulators are, and the regime currently is fairly business friendly if people follow it rightly, right? I mean, they're meant to support rather than create issues.
That makes sense.
So you have told us that how financing the cross-border transactions could be difficult and tricky at some places. So how would you say that there are innovative ways that companies can finance the M&A deal today?
Okay. As I said, anything that is difficult, innovation is an outcome of difficult things, whatever you see, right? So because we just spoke about it as difficult, companies and financial, let's just not just put it on companies, but let's also look at capital providers, right? Like they also try to get into structures and solutions, because companies need money, and they will, realize value by M&A, and financial capital providers also want to sort of engage in such activities because that gives them the return on investments they're looking at. So those workarounds are whatever innovations, if we may so call them. In an Indian context now, a lot of this is practiced through alternative mechanism like banks, and to some extent are regulated, but there are NBFCs who have greater leeway. And there is a structure known as an alternate investment fund, both on the equity and lending side, because it is private capital and more sophisticated, investors who understand risk, unlike banks who are dealing with depositor money and are, guided from being more prudent. These structures emerge. There is also, structures that incentivize managers of these NBFCs stroke AIFs to sort of outperform, traditional counterparts by, indulging in safer, sophisticated private credit opportunities. And from a cross-border standpoint, every country, including India, sort of has left legitimate windows open to structure. While you could bring, money, simple equity, but you could also structure that through a convertible or a hybrid instrument. Just like you have safe notes in the US, you have convertible notes here. You can also raise capital through convertible debt or convertible preference shares. All of this sort of balances between what rights investors are looking for and what commercial outcomes parties want to achieve. So I think the tighter the laws, the more the innovation will be around them because you know you can't stop business activity, right? It will find its way. It is like water; it will figure out a way and it will plan, and eventually laws will then play catch up.
So, sir, talking about further the fact that there are, in what ways environmental, social, and governance regulations influence M&A transactions and their approvals and valuations? Because as we know, these are playing a very huge role nowadays. That there is aware, they are people are being aware about these considerations as well.
I think not just M&A. If you look at everything in life, right, including what you guys are consuming, supporting, and all, right, we are all, at least the educated part of the world, is conscious about the impact of what we do on environment, on sustainability, and the G of that is on governance, right? Which means we want to, just like you won't support a team which is accused of fixing or booking, or you will not support a celebrity who's not ethical in conduct, or a company that has been accused of misdoing. Everything today uh, has this lens of being not just compliant theoretically, but having the right impact on sustainability, on the environment, and of course on governance, right? Which is very, very important. Like uh, companies that are well governed, even though grow at a slower pace, will have sustainable growth outcomes, etc. Companies that sort of factor the environmental impact of what they do tend to last longer and have a more credible impact. It has reached to a level where a lot of funds or capital providers have now put in conditions to say that the ESG scores should be monitored and mapped, and their capital is either available only for companies that are ESG focused or compliant, or available at slightly better rates than a polluting sector or a road or something. I can give a very basic example, and you will you guys are based in NCR, so road as an industry, for example, is also road construction brings with it a lot of pollution, and there is one basic norm that when a truck leaves the construction site, even if you just wash its tires, the pollution impact, right? Because the sand that just rolls in the 8 tires that a truck has is so high that it spreads. And there was a lending transaction I was looking at, which sort of, while everything else during that they were trying to do best, of course, what you can, right? To construct roads, it will be polluting. But let's say to have the tires of the trucks washed in and out was to that level. Now the lender is saying that we are monitoring this impact as well, and you need to show us that on all your entry exit points you will be able to sort of comply with this, not just in photographs but in real things. And of course other things which use more technology, use better bitumen, reduce the grinding dust, etc. And for real estate and manufacturing, of course, but people just, when they think ESG, they think of factory with pollution. But these are sectors that also need capital, and people are getting such granular level of compliance. Or if you look at any food delivery and all, or anything that you buy online, right, you're getting it in paper bags and all, because their investors are telling them that you have to focus on sustainability or net zero and have this impact. So when investors or where consumers have the nudge that this is should be focused, founders or business owners will automatically do that.
And so we have talked a lot about taxation. And so how do tax implications actually influence the structuring of spin-offs and divestitures?
Yeah, as I said, tax is a cost, sometimes a consequence also, but most often a cost, right, over and above what you, let's say, commercially desire to pay for merger acquisition. Now, when it comes to spin-offs or demergers or divestment, sometimes this is also an internal restructuring that companies do. And when you're restructuring and when you're doing a transaction, when you're really getting money, people are, they gulp the tax cost. But when they're, let's say, saying restructuring business or realigning how they conduct or, repurpose their supply chains, because that's more internal, inward looking, they don't want to pay a tax or defer taxes there. So when they are planning such things on change of structure, corporate capital, supply chain, to some extent, there are provisions in the tax law, like I mentioned earlier as well. You could do tax neutral demergers, etc., and some amount of capital structuring. But otherwise, you have to, get into some more sophisticated structuring to sort of get closer to the tax neutrality or the tax deferral provisions that exist in law.
So, what is the factor that makes a merger successful, and what are your views on the cultural integration after the merger? Because that also plays a very vital role. Some mergers happen, but they don't work very well because of the cultural differences.
I know, and this is true. Everyone understands it, but it's just that the M&A teams who drive mergers are finance guys or corporate guys. Uh, I think the global companies or MNCs who've done a lot of mergers have realized that the successful outcomes are in integration, not just, getting access. And they will have integration teams sort of work in parallel during the whole M&A and not just told that, okay, now we've acquired this and focus here on the HR, the softer parts of integration in terms of policy, in terms of technology, in terms of just conduct with the ecosystem, vendors, suppliers. But if properly done, the results, and that's where I'm saying, right? Let's say seller is selling at fair value, buyer is buying fair value. There's no money to be made, right? So the money really comes in the efficiencies that kick in with the integration. It's not just about scale, but it's about people working harmoniously together for one larger purpose and aligned with, if change everyone would resist, the company that is getting acquired as well as the company who's acquired, because they've suddenly now a different set of people, processes, systems to deal. And it's human to resist that change. But if it is planned in a methodical way, uh, and as long as I've seen organizations have 2 to 3 year plans, it's not like 2 to 3 months that you wish away that people issues or technology issues will not come in. But 2 3 years are spent on just integrating, bringing internal efficiencies, and then sort of refocusing on why you acquired and what was the market or the external advantage you wanted to achieve. So it is less glamorized, but it is very important. And the people who play that role, as I said, do it after the Big Bang announcements and the newspaper ads have gone in. But they toil to really get the real deliveries, right? The real value addition come out of a deal.
So, with this, we would like to conclude the interview. Thank you so much for gracing us with your presence and sharing the insights with the decades of experience behind them with us. I'm sure our audience will be enriched with this knowledge and it will help them further in their careers. Thank you so much, sir.
Thank you so
Thank
much.
you. Thanks so much. Thanks, Aditya.